If you're investing in stocks, September was a pretty tough month, as it seasonally tends to be. And October so far really hasn't started much better. Especially what you have in your portfolio are companies from the tech sector, the darlings of the pandemic. Companies like Apple, Microsoft, Facebook, Square, PayPal, Moderna. But what this sell-off represents is not only an opportunity to buy these stocks lower when the market finally bottoms out, but also to diversify into other places that will benefit from the second reopening. Companies that are undervalued or have been neglected by the market, or simply leaders in other sectors that are not in the tech domain. I've spent the whole weekend dissecting the conviction list report. This is a report that Deutsche Bank publishes once a quarter, and that gives you the best ideas for the following 12 months. Let's look at them. Conviction list from Deutsche Bank is finally out again. And if you follow this channel, you know that every quarter when Deutsche Bank publishes this report, I talk about it on the channel. I talk about the stocks that are contained in the report. But if you haven't seen one of the previous videos, let me just throw the first page of the report on the screen. This really kind of establishes the credibility. What Deutsche Bank does is they ask their analysts for the very best ideas in terms of stock trades for the next following 12 months. And they track their performance. So you see here, over the last 4 quarters, how that compares to the S&P 500. And if you look over the last 12 months, the stocks that are contained in this report are up 42% or almost 42% versus 29% for the S&P 500. So that's 13 percentage points better than the S&P 500. So this is a serious report. This is a report that I pay attention to, that I take inspiration from for my ideas, for where I want to put my money to invest, and obviously tell you about them here. So this quarter we have 13 new ideas, 14 updated ones, so that's 27 names in total. I'm going to leave all of the names below the video. We can talk about it in the comment section. Obviously we don't have space and time here to talk about 27 names in detail. So I picked my personal 5 picks from this report that I'm going to talk about over the next following 10 minutes or so. But if you have any questions about any of the names that I will not mention, or even the ones that I talk about, leave it in the comment section and we can talk about it. All right, let's dive right in. The first company from the report I want to talk about is a classic reopening play, and that's Las Vegas Sands, which operates casinos and convention centers around the world. Now, before we go on to the actual story behind the stock and the catalysts of why it should be trading much higher, let me just show you a couple of charts from Bloomberg that kind of give you an idea of where the stock's been trading and where it should be trading based on the analyst community. So the first chart that I'm showing you here, this is a 5-year chart of Las Vegas Sands. You see in 2018, we were as high as $80 a share. Today we're at $37 a share, so obviously much lower. And in the very worst of COVID-19 in March 2020, we were trading at $33 a share. So right now we're only $3 or $4 higher than we were in early 2020 when COVID hit and everything was shutting down. So that's a huge, obviously skewed risk-reward scenario just in the stock price, right, of where we used to be a year and a half ago to where we are trading today. Now, this other chart that I'm putting up on the screen here shows you the analyst recommendations community. This is all the Wall Street houses that are following the company, are putting up research and giving recommendations. And if you look at the top left corner of the screen, you see that 8 analysts have a buy recommendation, 7 have a hold recommendation, and the 12-month target price, so the average of all of these recommendations together, is about $57, $58. So that's a 55% upside from the current level at $37, right? And Deutsche Bank arguably is one of the more aggressive ones. Their target is 73, so that's 100% potential appreciation for the stock. Now let's talk about the company. So this is a company that has a huge history in Las Vegas for a very long time, run by Sheldon Adelson until he died early 2021. They recently sold all of the assets on the Vegas Strip, the Venetian Hotel, the Expo Center, the Convention Center, that's all gone. So now their businesses are twofold, right? They have one business in China, in Macau, and the other business is in Singapore, the Marina Bay Sands. So let's talk about the Chinese business, and this is one of the reasons why the stock is so depressed. The Chinese authorities are about to come up with a new gaming law, which effectively awards the gaming licenses to foreign operators in Macau. And there's a little bit of uncertainty of how long this might be, whether in fact they will even award these licenses again because of how they've been cracking on a lot of industries in China. Now the market consensus is that they will renew these licenses, maybe not as long as they used to be. I believe that was 20 years, so the consensus now is maybe 10 years, which would be good news. But there's clearly a lot of uncertainty and nervousness around the stock because of that. Now, the other side of the business is in Singapore, and there's really no issues there. In fact, the Marina Bay Sands, this is the Singaporean operation, the casino convention center, will have a giant property expansion that will reopen in 2025. And when you look on the valuation basis, just the Singapore business is valued at about $35 a share. So we're trading at $37 right now. And $35 of that is what the Singapore business is valued at. So there's very little downside in terms of what actually happens in China. So here's a stock with two catalysts. One is the clear reopening from COVID-19, and the other one is the Chinese decision that will come up very shortly over the next few weeks. The second company on this report that I want to talk about is Delta Airlines. And if you follow this channel, you know that I talk about Delta a lot. This is one of my biggest holdings, and I follow this company very closely. And there's a lot to say about how well they are positioned for this huge recovery in demand for air travel and how the risk reward is really skewed in their way. So they're really going to benefit from three levers here when it comes to what the stock is going to be doing. There's going to be, number one, a huge recovery in earnings. That is really pent-up demand in corporate and long-haul international travel. So that's number one. Number two, they are really benefiting from a huge a restructuring of the balance sheet and deleveraging, something they've done in the past successfully. And three is the savings that they are realizing from the pandemic in terms of how they are structured in terms of their fleets and fuel savings. So let's talk about the three. Number one, the huge earning expansion that is really coming up, right? Delta Airlines is one of the airlines that is the most leveraged to corporate and long-haul international travel. And when you look at the corporate travel, we had a huge uptick between March and July when really COVID cases were declining rapidly. Then it somewhat stalled. But whatever happens over the next 90 days or so, it doesn't matter almost. We will emerge from COVID-19 over the next 6 to 12 months. And corporate travel is coming back. I get people that I work with ask me every week if they can come and see us, if travel's coming back when it comes to corporate travel. Now, on the long-haul international travel, don't forget that in November, the United States is going to be lifting the travel ban on non-essential travel. So suddenly you'll have countries that, provided they are vaccinated and they have a negative COVID test, travel's now allowed again back to the United States from Europe, from China, from India, Iran, South Africa, Brazil, all of these huge countries that are going to be a huge boost for Delta's business. Now, let's talk about the second lever, that's the deleveraging. So I want to show you a chart here. I'm going to throw it up on the screen here. Back between 2010 and 2015, Delta Airlines went through a massive deleveraging cycle on their balance sheet. They reduced their debt from $17 billion down to $4 billion over those 5 years. And you see the stock went from $10 a share to $50 a share. So this is the performance that you will see in the stock market as Delta does something similar over the years to come. Right now, they have about $18.3 billion in debt, and they already started deleveraging. They already started prepaying in terms of the pension plans and paying back some of the debt. The third lever is really the structural, the permanent cost savings that they realize is a kind of a silver lining from the pandemic. If you look at the results of the last couple of quarters, in the March quarter, they realized a 12% efficiency saving in terms of fuel costs over that quarter. If you look at the June quarter, they realized another 7% of fuel efficiency savings. So they are really saving a lot of money in terms of how more efficient they are running the operation. And that's also related to how they're changing their fleets. They had 13 fleet families in 2019, and that's going to go down to 9 fleet families by 2025. So they're getting rid of a lot of the older planes, the non-efficient planes. They're simplifying their fleet, which obviously then saves costs, not only in fuel costs, but also on maintenance, on how they have to run their programs, train people. Everything is becoming a lot more simplified. And finally, when you look at the stock price, the stock is trading at somewhere around $45, just below $45 here. If you can get it in the low 40s, it's an absolute no-brainer, because this is a stock that, first of all, is trading behind the index. When you look at the overall airlines index, Delta is somewhat undervalued in terms of performance so far this year. But this is a stock that's going to trade somewhere in the mid-50s by the end of the year. So this is a clear no-brainer. You know that recovery is coming in airline travel. You know that Delta is one of the airlines that is the best positioned in the sector. They have one of the best balance sheets and an operation that is running super smoothly. The third company on the report that I want to talk about is not a reopening play, nor is it a very cheap stock at this point, but that's because it's a leader in an industry that is registering phenomenal growth, and that's Albemarle, ticker ALB. So obviously, if you follow the EV car industry, if you follow the lithium market, you know that Albemarle is one of the biggest producers of lithium in the world. They have 2 new world-scale projects that are coming online in the first quarter of 2022 that will increase the capacity for lithium for them by more than 80%. So if you think about the growth of the lithium market and the pressures on pricing in lithium that we're registering here because of this huge demand, the demand is forecasted to have a compound growth of 30% until 2025. So that's a huge, huge growth and price pressure on lithium that Albemarle is benefiting from, and they're on track to become a pure play lithium company. You see this in the headlines around you. You see Tesla just reported record deliveries in the last quarter. You see GM just put out a Hummer that's electric. That seems like an amazing car. Ford is about to start selling the F-150 that's going to be all electric. You see this all around you. And GM, by the way, announced that by 2035 they will be all electric. No more gas-powered cars. 2035, that's actually not very far from here. And that is going to translate into a huge demand for lithium, which Albemarle is going to be benefiting from. So let me show you this chart here. This is the 5-year chart for Albemarle. You see that clearly we're not at super low levels here. We were trading at $50 a share. When COVID hit, we were somewhere around 50 to 150 in the past. Now we're above 200. But the sell-off that we're seeing in the market right now is trading about 215. If you can get it around $200 or just below $200, I think this is a great moment to layer yourself into the stock and start picking up some Albemarle and benefiting from this whole move of price tightening that is going to ride out for the next 10 years. And if you don't want to be in Albemarle, if you don't want to be so concentrated in one company, you might as well invest in the lithium ETF, ticker LIT, which has Albemarle, 14%. This is, by the way, the biggest holding of LIT. Is Albemarle, and you have other companies from China, from other countries. You have Tesla that's part of this ETF as well. So that's another way to kind of play this whole lithium move that is going to be a huge theme for the next 10 years. The next company on the report I want to talk about is a company called Ringcentral. This is a company that's directly competing with Microsoft Teams, with Zoom. This is all about cloud communications. And just to give you an idea of where this stock was trading over the last 12 months and where it should be trading based on the analyst community, I want to show you those two charts here. Again, this is the last 12 months of where Ringcentral was trading. And you see that early 2021, in February at the high, we were as high as $450 a share. And today we're trading at $216 a share. So this is a lot lower than a few months ago. But when you look at the analyst recommendations community, you see that of all the houses, the Wall Street houses that research this company, look at the financials, analyze, and give recommendations, at the top left corner of this page, you see that 92% of them, 24 out of 26 houses, have a buy recommendation, and only 2 have a hold recommendation, and nobody has a sell recommendation here. So again, just below you see the 12-month target price, the average of where all of these Wall Street houses are recommending this stock should be trading and what they think the target is. We're at $402. So this is a monster upside from 216 from the current pricing. And so just without going too technical here, this is a company that really is going to be front and center of where we are heading, right? This is going to be work from anywhere. We'll be able to go to the office, work from home, work from an island, whatever it is. But at the center of all of this is communications. And when you think about how we communicated before COVID-19, the so-called PBX licenses, the private branch exchange licenses, this is effectively the phone and the line that's connected to the phone on your desk at work, right? So that whole thing is over time going to be migrating to the cloud, and they are right in the middle of it. They have huge, substantial partnerships with all the leaders in telephony, with Alcatel-Lucent, AT&T, British Telecom, Vodafone, Avaya phones, right? This is what you have in the office typically. And nobody has these partnerships. Nobody has that kind of front seat in the middle of this industry as it's going to be transitioning to the cloud telephony, how we're going to be communicating, when the world somehow then comes back in some kind of a hybrid mode. So Ringcentral, huge growth potential. The stock sold off over the last few months because the market is worried about, are they going to be able to sustain the growth rates that we have been seeing over the last few quarters? But clearly, this is a huge total addressable market that we only are, at the very beginnings of kind of transitioning from the classic phone on the desk with a line to some kind of a cloud-based telephony, how we communicate. It's not always going to be Microsoft Teams and Zoom, right? You still need your phone number, you still need to communicate with your phone somehow, and Ringcentral is right there to capture that market. The last company from this report I want to talk about today, and I was super happy to see this company on the report because it's a company that I've been watching for a while, is a Brazilian fintech called PagSeguro, ticker PAGS. And before I give you more details about the company, I just want to show you again this page on Bloomberg that shows the analyst community recommendations here and the consensus. So you see, for a company that you may not have heard too much about before, you see that 95% of the houses, so 19 out of 20 recommendations is a buy recommendation. One house is a hold recommendation. And if you look just below the 12-month target price, the average of all of these investment houses is around $68. So we're trading just somewhere below 50 right now. $68, again, a significant upside. In fact, I think it's still too low because this is a company that is effectively the Brazilian version of PayPal. So think of PayPal and Square in the very early innings, 10, 15 years ago, when they were just connecting merchants, getting into the market. This is where PagSeguro is. And Brazil, this is a stock that's listed on the US stock market, but obviously Brazil, an emerging market, a somewhat underbanked market by Western standards, right? Which obviously creates a lot of opportunities. So PagSeguro is growing rapidly. Their revenues are up 89% over the last quarter. They added 2.1 million users for a total of 11 million users. They are increasing the amount of hubs across the country. So they're going to have somewhere between 250 to 300 hubs online by the end of the year, just to be closer to the consumers. But this is a real opportunity to invest in a fintech in an emerging market that is proven, right? We know that this business model works. We've seen PayPal and Square grow to very mature companies that are adding other features. And PagSeguro is doing the same thing. They're adding credit cards, they're adding loans, they're connecting merchants across the country because, like I said, a very underbanked market where you still can charge a lot more for kind of regular services that you and I, for example, consider probably should be free or should be very cheap. But PagSeguro is able to kind of benefit from a market that is still quite inefficient. All right, so much for the latest conviction list from Deutsche Bank. Again, like I said, this is an amazing report that I like reading. I like deep diving into it, understanding the rationale behind some of these recommendations. It gives me ideas and inspiration, and obviously I love talking about it on this channel here. So 5 of my picks that I detailed here, all the other ideas. So in total, we have 27 names in this report for this quarter here. Everything's below the video. So if you have any questions about any of the stuff that I talked about, any of the other ones that I haven't talked about, but they're listed below, leave it in the comment section. We can talk about it. I'd be curious if you have invested in any of these names, if you hold positions in any of these names, and what you think about the companies. Anyway, thanks for hanging out today. Make sure you give a like to the video, subscribe to the channel if you haven't yet, and I'll see you in a few days.